For straightforward bullets on the market, which have been pointing out dangers lurking from aggressive Federal Reserve action, and of course the weakening economy. Joining me now to Kobeissi, letter editor-in-chief, Adam. Adam, first of all, I love your tweets. Okay, I want to put up one that you had over the weekend I thought was interesting. You said it's remarkable to think that we are in a recession and the bull case is 75 basis points. We're talking about raising interest rates at a historic pace into a recession. So you mentioned that twice, and of course you go on to say this can't end well. What do you mean by that?
Yeah, so it's pretty interesting right now where we're seeing the Fed tightening into 2 quarters of declining GDP. And it's kind of an interesting narrative right now because the Fed is effectively stuck, right? They acted a little bit too late. Now inflation's soaring, the economy is slowing, and they have to be as hawkish as possible. We saw this false rally in the summer on the hopes that the Fed would take a middle-of-the-road approach. But as we look ahead to tomorrow's meeting, we don't think that the Fed can take any middle-of-the-road approach. They have to be maximum hawkish, pedal on the metal, and then they can start to dial back into next year.
So then with that in mind, I know you're more medium term, but because of the volatility, you've taken some shorter term plays. I want to talk about the S&P because from what I read, you're short right now.
Yep.
I think you're looking for 3,800 with 3,900 as a stop. So you're just looking for a trade here. When would you close this out?
Right, yeah. So we launched this at the beginning of this week with the narrative that we're going to sell off into the Fed meeting. We think this has been a 75 bips rate hike is largely priced in. If they come out of the blue and raise 100 bips, which we're not expecting, yeah, we'll fall significantly. But then from there, we're expecting this kind of counter Fed trade to bounce a little bit. We'll see gold, commodities, S&P rally. But ultimately, we think every rally is still going to be sold in this market until inflation starts to come down, especially as supply-side inflation worsens.
So in the meantime, the bond market going crazy, right? Bond yields are through the roof. TLT is long bond. You're saying stay shorted. You're looking for a move down. I guess at least here, maybe even lower. But to me, it looks like, I know you're looking at this maybe as a trade, but could it go even lower? I mean, how much danger are bonds in right now?
No, absolutely. I mean, we're going to see the Fed continue to raise into at least Q2 of next year until we see any sort of relief. And we actually think we're going to see some deflation before this market bottoms out. So, deflation, you have high inflation right now. You're going into deflation. You have the Fed as hawkish as they've ever been. We don't see the long bond trade as a good trade for another few months at least. One
of the areas that's looked intriguing for a lot of people is the oil area, particularly the oil stocks. Now, obviously we've come down a lot. We're at this real big potential inflection point. You're neutral on it. Where would you make a decision whether to go long or short?
Yeah, I mean, we saw a lot of upside earlier this year on the headlines with Russia and Ukraine and OPEC. We think a lot of the good news is baked in here, and especially with a hawkish Fed, the dollar is going to continue to strengthen. So we've been actually selling rallies in oil since we topped out earlier this year until you start to see signs of actually inflation peaking, which seems counterintuitive, but you need the Fed to dial back before commodities can really start to rip higher. Otherwise, we think lower highs are going to continue to form.
Gold miners, that's a place to hide out now?
It's good over the short run, just like we said for the counter trend play right here, but we're seeing lower highs where we think gold will continue to sell into next year too.
So for the most part, you kind of take what the market gives you, right? One thing I like about your letter is that you're not saying this should happen or that should happen. You're saying this is happening, right, and this is how we take advantage of it.
Yeah, no, I mean, there's an age-old saying, right? You got to trade the market you have, not the market you want. And that's how we look at it, right? I mean, nobody wants a market with the Fed tightening into a recession, but that's what we have here. It's going to continue. It's actually going to create a fantastic buying opportunity once the dust settles.
Right.
And look, if you're long-term oriented, if you're looking at your 401k, don't, start going for some high-quality names. Maybe average down into the end of the year, into next year. If you're in the short run, yeah, there's some downside opportunity. But once the dust settles, this is going to create a pretty interesting.
And it's the Kobeissi letter.
The Kobeissi letter. Yes.
All right, my man. Great stuff. Appreciate it, Adam.
Me on.
All right, coming up, I'm going to share some of my own options.